Welcome back to the course. In this lecture, we're gonna be learning about effort versus result analysis. Okay, so let's get started. So the core question that that we need to answer is that the effort, you know, which is the volume, and the result, which is represented by the price spread or movement of the price. Okay, so first of all, effort is your volume, and result, what's the result of applying that force or that volume into the price, and that's how the price move. Okay, so the question is, does the effort match the result? you know if if you remember, Newton's three law, we have also like Wyckoff's three law. Wonder why there's three law only. you know. So if you remember in Newton's law, it says you know uh, the object stays in motion until and unless the force is applied to it, is equal or greater than that. Then it will stop. All right. So that's why we need to match if the effort matches the result, and that's how the price moves or stays or stops. Those are the questions that we can answer after understanding this. Okay, so let's continue. So this is your decision matrix, where how you interpret this now is you have large volume column, row, small volume row, and then high volume. Sorry, this is the movement of the price. This is high volume, this is low volume. All right. So if there is harmony, okay, meaning strong conviction, follow the move. Meaning volume is high, price is large. Effort is good, result is also good. That we call it harmony. Okay. On the other hand, if the volume is low, all right, and the price is large, that means it's a thin move, which is unsustainable. Do not chase this. All right. Second is a third is your volume is high, but the price movement is small. This is what we call divergence, and the absorption is occurring there, and prepare for reversal. All right. Fourth one is there is low volume and the move is also small. So there is basically no interest in the market. That's why the move is very small and the market is going to rest. So wait for the next move. All right. Moving on, let's analyze what is harmony is, where we discussed. So let's discuss what harmony is, where effort matches result. You know, high volume and large move. So this is where institutions are committed to this direction. The move has conviction. You can see here, all right, there was very large move and large volume. So this is what we call harmony. All right. I mean, like, you can see if I plot this here from this point onwards, there was conviction that the market is going to go down, right? So this is where volume, which is effort, it matches the result. All right. So this was your price. All right. So we see widespread candlestick and high volume, follow through happens. Okay. You see very high spread, right, and the volume was very high. Okay. So follow through to the downside. On the other hand, if this was the case for market going up, we follow to the upside. Okay, because the institutions are committed to this direction and the move has conviction, and we can see that. Okay. Divergence is when effort doesn't match the result. Okay. So when there is effort, all right, and if the result is doesn't match, is it's not matching, all right, then we call it divergence. Okay. So what happens is we have high volume but the move is very small, you know, or the move is very big, I mean like it's making new high but the volume is less, you know, we call it divergence. Okay. That means something absorbed the move where supply met the demand or vice versa, which I told you. This is a reversal warning. Okay. And this is one of the best signal that you're going to see. All right. I'm going to teach you guys how to uh, identify those. You see, we will see narrow spread but very high volume. Okay. You see around here, see this candle. Okay, just observe this one. Okay. If you notice, I'm just gonna put it here. All right. If you notice, this is very small candle, but the volume is very big here. You see, right? What does it show is that supply something is absorbed the move, meaning it was going down but something absorbed the move, meaning supply is meeting the demand. That's definitely happening here. Okay. um, and so this is your one of the best signal for reversal warning, you know, and we can see from that point onwards market just goes up. All right. So this is your divergence where effort is not matching the result. All right, and the reversal must happen. Thin move, which indicates no real support, is where low volume makes the large move. All right. So the what it means is that the move was easy, but no one on the other side is there to support that move. You know, so this move tends to retrace, and I'll show you what it means. All right. So you will see widespread candle, but the volume is very thin or low, and that's why we don't chase it because it's likely gonna retrace. Okay. So let's find this example in the chart. Widespread candle, but low volume. See here, very widespread candle, and the volume was low. I mean, it was higher than that one, but yeah, it wasn't, you know, above the first standard deviation or moving average for that matter. Okay. Uh, Let me actually show you guys what it means. All right. So that it's actually much clearer to, you know, analyze this. Okay. So here, let me actually get the whiteboard. Okay. Hmm. You know what? Let's just continue here. Okay. So if you see, uh, the volume is shown like that. Okay. This is the volume for that, volume for that, volume for that, like that. What we will do, we will actually take the average of 20 volume, all right, and just plot it here. So what you see here, this line, that's the average of the last 20 volume that came, you know, and what you see here is the standard deviation of that. So first, second, third. And if you remember this chart where market, you know, in statistics we learn this is what we call mean. All right. And then we have first standard deviation, All right, first standard deviation, we call it sigma, minus sigma. And then you have second standard deviation, okay? And then you have third standard deviation, which is just a distance from the mean, okay? This one, this is your mean price or mean volume or mean anything, okay? Because this is the average of that, all right? Um, so here, if you see this one, like, like that, you can actually, we know that the volume is going to be positive, right? So we are just like plotting and looking at this one, uh, this, because like, so this is positive, right? Imagine if there was negative as well. So like your chart would definitely would look like this, and you would have your mean here, right? First standard deviation, second, third, and that's what I'm showing you guys, 1 2 3, okay, 1 2 3. All right, so this is how you can interpret the volume, and now you can actually categorize them, okay? If it's a low volume, then if it's below the mean, you know uh, or first standard deviation for that matter, that's low volume. All right, if the volume is about third standard deviation, that means the intensity of the institutions or buying or selling is very high, and you can see that, right? So this is how we are uh, basically like differentiating between what volume categorizes as low volume or high volume. Okay, so now you know that this here, this candle volume is a low volume. Hang on. Okay, so now we know that, like, this is a low volume. So what will happen, let me actually get to that one. Yeah, here. Okay, so what it shows is that, like, we don't have to chase the move, to the downside, because what happens, market actually traces to the upside, right? And then it continues down. So we would be basically get stuck in this move for, long time. And you can see market actually doesn't even go further, like, right? It just stays there. So don't chase that. All right, that's the message of this. Just be holistic with it, and like apply the market, apply the principle when we see big move, like when there is divergence or when there is harmony. Okay, so how to apply step by step is that, first of all, you need to identify the volume. All right, because volume is the most important thing in the market, and that's what the institutional traders can't trick ourselves. All right, trick us. They can lie with price, but they can't lie with volume. Okay, so first of all, identify the volume. Is it high or low relative to the recent average? And that's what I told you guys around here. Okay, is it high or low relative to the recent average? And if and the intensity of the color also shows if the volume is high or not. Okay, second, measure the spread. Okay, is the bar large or small range, right? As we have done for this, we can do the same thing for bar as well. Okay, and compare, does the effort matches the result? Okay, does the effort matches the result? Here you can see, right? Well, this was very high move. All right, but I mean, this is one of the biggest candles so far. All right, uh, but the volume is not that much, like, it's not that climactic volume. That's why market stopped, and, like, we saw the reversal. So effort was there, result was there, but the effort was less. Okay, com- considering that, like, it's still purple volume, but relative to what came before that, you know the move, like you see on this candle, the move was, less, the volume was very high. Here again, right? Here again. Okay. So now see this one here. See, this move is like valid, because you see here, very high volume, candle had good movement, good, right? Here it's less than this one, but volume matches the price, but if you come around here and you see this big move right there, and I'm gonna actually do that. Okay, so this is from this candle, which is the smaller one. You see very big move, but but the effort didn't matches that, right? So that's why market actually stopped right there, and it didn't continue, followed through. Okay, it was there, right? Okay, and then here you can see effort is matching the result, the market just goes up. All right, so compare, does the effort matches the result, and you will actually see the truth in the chart. Okay, fourth step is interpret through phase context, like which phase the market is in right now. Okay, so context on accumulation is no interest, divergence, which is where supply appearing, and then harmony, sign of strength. Okay, what it's telling you is, if this is my accumulation, okay, this is my accumulation, we see, uh, selling climax, very high volume, then it diminishes, the volume diminishes like that, right? Supply is being absorbed, right? Which is basically like, you know market is absorbing the supply, and then we see harmony. Okay, so here it says divergence, supply appearing, meaning, uh, you know we are putting the effort, but there is no result, right? You see, market is like they are trying to push the price down, right? Price down, but it just can't go down, uh, and that's what we call divergence, which is like, it's showing supply appearing, but it is basically absorbing the supply. And after that, we see sign of strength, harmony, and then pull back, and then boom, market goes up, right? So initially we see no interest. You see no interest, no interest, and then we see some interest, but market can go down. We see sign of strength, right? And then pull back, and then market goes up. Another sign of strength, and then, like, you know, the cycle repeats. Okay. In the context of distribution, what happens is that we see thin rally, unsustainable move, uh, like that. You see, volume is less than that. You see, less volume than previous one. The market made new high. If the volume is less, why is it making new high? Just think of it. That means the move is not gonna be sustained. And the market has to reverse. Okay. Then we see divergence, demand, temporary. I mean, we do see this temporary demand there. All right. uh, Temporary demand, like that. Okay, another temporary demand, like that, and the market just comes down after that. Harmony, sign of weakness, very strong down candle. You see, this is the sign of weakness candle. This is sign of weakness candle, right? Even because it was closing below that low, then the temporary demand appeared. You see, volume was decreasing, right? You see, like there's not much volume around there, and then the market goes down from there. Volume was increasing. Harmony, sign of weakness. See, very strong volume candle closing below that, market goes there. Okay, so that's your distribution context. All right, so critical point that you don't need to ignore it is traders most traders ignore the narrow range bars with very high volume, and they think nothing happened. But I mean, something did happen, right? Because we know that the institutions leave their tracks with very large volume. So high effort, small result means there is absorption happening. All right. And this is one of the most important signals you can find in the market. Okay. And let me show you. I actually wanted to just like, as soon as I saw that, and I was thinking of showing you guys that as well. Okay. Uh, Here you will be seeing sign of weakness. It's basically showing on the wave. We saw sign of weakness. So like considering the wave, the follow through will be downside. Okay, and that's what it shows. Uh, when I talk about the candle, right? You see this candle here, this one, very high volume, right? Uh, but the move is not there, right? So this is a narrow candle. I mean, relatively speaking, you can see very big volume. But high is the biggest, I mean, relatively speaking, along with them. All right. So there is going to be reversal happening, and you can see absorption happen there. Okay. So the market is going to stop, and, it reverses there, goes to the pullback, and then just goes down from there. Okay, yeah, I mean, you can see all this happening again and again. You can see here 277 unit of volume here. This was 45 units of volume. On the upside, we went with very high volume, but market closes below that. There was effort, but the result was very less. Okay, market comes down. Okay, this is one of the best reversal signal you're going to be finding. Okay, this and divergence. Okay, so practice exercise for you is to do a bar by bar analysis into absorbing what the price and volume are doing together. Okay, so open any chart with a range. Okay, for each bar identify volume, high low, and spread, low high, I mean high low for that one. Okay, uh, and then label harmony, divergence, thin or no interest. Just go through that, and think of if the volume is supporting the move or not. All right, and if the price, which is f result, is reflecting that effort. Okay, and then note also the location. Where is it happening? Is it happening near the support, or is it happening near the resistance, or in the middle of the range? And then analyze 20 bars without looking ahead. Okay, so key takeaways from this lecture is, first of all, you need to look at if there is harmony with volume and price. Okay, that will show us the follow through. If there is divergence, meaning there is high volume but very small move, which I shown you guys here, right? That's a reversal warning. Okay, and the another opposite of that is low volume and big move. Okay, that's also a divergence. Okay, thin move is, see, this is low volume and large move. That's why we call it thin. All right, we don't chase this because we don't know for sure, like, if institutions is present or not. uh, so just don't chase this low volume and large move. Okay. uh Fourth is no interest, which is like low volume and small move, so wait for it. Market is basically getting ready for it. So see, low volume, small move, don't trade around here. You see, market just like manipulated those, and then when very high volume came, boom, market closes below that, and then it just comes down. Okay. So next up, we're going to be talking about climax volume identification, distinguishing from selling climax, buying climax, and from exhaustion tops. Okay, so I hope you guys learned about the volume uh, in this lecture in more detail, and in the next one, we're going to be continuing uh, learning more about it. Okay, so I'll see you guys in the next one. Thank you.